Joe, it's time to do another video update.
Okay, today is Sunday, April 17th, and we thank everyone for joining in. I'm Joe Terril, President of Terril and Company, and we will update you on our thoughts here on not only the worldwide economy, but the investment markets in particular. There are a number of issues that are currently affecting the worldwide economy, and we'll touch base and talk about those. But let's first start. I want to state that the worldwide economy right now is doing very well. It's doing well because you have 200 to 300 million people that have moved from the poverty area of the social scale into the middle class. And in doing so, they have a huge demand for goods and services. They want technology, they want automobiles, they want better food, they want better clothes, they want entertainment. In addition to this, the worldwide economy is benefiting from the fact that central bankers all over the world have flooded economies with currencies, be it Japanese yen, obviously US dollars, euro dollars, China. Everyone during most of 2009 and 2010 have flooded their economies with currency. So take the fact that we have that many people out there and a good demand for goods and services, take the fact that there is plenty of cash in the system, and we do have a strong worldwide economy. But that's about to change, unfortunately, and in just a moment I'll explain what I think will happen with the economy and what will also happen with investment markets. We have issues such as the European debt crisis, the earthquake in Japan, unrest in the Middle East, and in the United States, the most serious issue of all, an inability to deal with a major debt crisis in the United States. So we'll take these maybe one at a time and discuss first how they'll affect the world economy. I say that the world economy will slow down. The main reason that the world economy will slow down is it's time for central banks all over the world to stop the printing presses and withdraw some of the liquidity from their economies. This needs to be done to avoid very high rates of inflation. The United States is flooding the world with dollars. The world uses the dollar as a reserve currency, and the United States is exporting inflation to all these countries. The price of food is going up dramatically and rapidly, and we're in danger around the world of seeing discretionary spending by consumers disappear due to the fact that the average consumer around the world is going to have to spend every bit of their income on food and energy. So let's chat for a few minutes about the Japanese earthquake. Will not interrupt the worldwide markets. It's a tragedy, it's a human tragedy, no question, but it will not affect and interrupt worldwide growth. The European debt crisis is a similar situation. That will get worked through, and many of these countries are going to be on austerity programs for some time, but does not have the potential to interrupt this growth in the worldwide economy. Let's go on to the unrest in the Middle East. It's a major positive if countries can get rid of dictators, brutal dictators that sponsor terrorism and do not allow people to be productive. If we can get some form of democracy and a hint of capitalism introduced into these countries, it would be a big positive for the worldwide economy. The problem is, can we get there without the price of oil going to $150, $200 a barrel and price of gasoline going to $5, $6 a gallon? The answer to that I do not know. My best guess is energy prices are now going to go higher. The price of gasoline is going higher, and that price of gasoline along with the price of food is going to help choke off this worldwide economic recovery that we've been experiencing for the last 2.5 years. One of the biggest issues is the debt crisis in the United States, and yes, it's a crisis. We in the United States are under the impression we can print unlimited amounts of dollars and not have inflation, and that's ridiculous. Sorry, Ben Bernanke, sorry, Congress, you guys are literally screwing up big time, and we are going to have much higher rates of inflation continue. Inflation is here right now. Average inflation on a cash basis, forget on paper and seasonal adjustments, on a cash basis inflation's running 6 to 7%. That will slow the economy down. In particular, it'll slow the economy down in the United States. The Federal Reserve Bank of the United States has the ability to stop it whenever they want. All they would have to do is raise short-term interest rates from 0 to 2 or 3%, announce to the world they intend to restore the integrity of the U.S. dollar, that they are no longer going to do quantitative easings, and you would see commodity prices and prices in general come down sharply overnight. The reason for this is oil, cotton, steel, copper, all the various commodities are acting as money, meaning that people are using them for a store of value. They would rather own those commodities and have those in their possession than have US dollars or Euro dollars or any other currency. Who would want a currency when the United States is printing it like crazy and Congress is creating a demand with ridiculous budget deficits for them to come up with even more money? So the number one problem why we're going to see the worldwide economy begin to change course and go back to lower growth and probably even back into a worldwide recession is inflation due to excessive printing of US dollars. So let's talk about how that's going to affect the investment markets. Investment markets in general will be poor for now till at least maybe 12 more months, something like that. Again, it depends upon the Fed and what type of actions they do or do not take and how fast they do or do not take them. No one wants anything to do with a bond, a fixed income type investment. As inflation goes higher, it tends to destroy the principal value of the bond. If they raise interest rates to contradict the problem of the falling US dollar, higher interest rates are also bad for bonds. So I agree with a number of the large institutions out there that no one that's paying attention, there's no need to buy a US government bond. You're only going to end up losing money in the investment markets in it. And the only bonds we currently own at Terril and Company are short-term bonds that are due in the next 12 months or less, and that's simply to make some form of rate of return while we're trying to position ourselves very defensively to sit out what we think is turning out very soon to be very poor investment markets. The equity market is a little more puzzling. In general, inflation short term can be very bad for the equity markets. I would think this would be no different this time. Corporations dealing with higher cost, it'll hurt corporate profits, and as corporate profits are hurt, prices of equities will come down. But a little longer term, if the Fed really lets this go too far, equities will tend to come back into favor because people will look at them as an alternative to holding currency. In other words, I would much rather own a corporation that owns the means of production than have my money sitting in paper in a money market fund or on the sidelines. A corporation somewhere down the line is selling a valuable product to the world. They'll be able to sell it at whatever price makes sense. So short term, when they can't raise their prices, they'll get hurt. Longer term, they're able to raise their prices, corporate profitability will return. But for the next year or so, I really believe that we're going to see somewhat poor markets for equity. You tell me what Ben Bernanke and these guys are going to do at the Fed. If they're going to tighten right away, you want to own the US dollar, it'll be very, very positive for it. If not, and they really think they're going to keep interest rates at zero, or any crazy notion they might do quantitative easing number 3, then you don't want any part of the dollar, run from it. It'll continue to fall in value. The rest of the world, central bankers around the world are raising interest rates in their country. They're doing the correct thing. They're withdrawing liquidity. They're increasing interest rates. They are also putting pressure on the United States to, if you will, stop the insanity, United States, and start being physically responsible. And I don't know that we're going to do it. I hope we will. I hope maybe that they can intimidate us into doing the correct thing by refusing maybe to buy our debt. What they don't buy, the Fed's printing anyway. So in general, in investment markets, we're becoming very defensive until they do raise interest rates or give an indication they're going to raise interest rates. You have to stay with the commodities. Gold prices will continue to slowly go higher, as will the prices of soybeans, corn, cotton, steel. This cycle in commodities will continue higher until the day the Fed gives a clear indication they're going to stop printing money and raise interest rates. So just to recap, we have turned negative on the investment climate for the first time in about 2.5 years, and I think it's warranted that we try and become very defensive, because the Fed is just on the cusp of letting worldwide inflation get out of control, and it'll be bad for the world economy, and it'll definitely be bad for investment markets. Thanks for joining us today at Terril & Company, and we will keep you up to date. And we do not like being negative, but we like protecting the principal value of our clients' portfolios more than anything. And when it comes time that you got to be defensive and negative, we're willing to do it. So let's hope that somewhere the Fed gets the message and they do the right thing. That would be positive, as I mentioned. And if they do, we'll be more than willing to switch. But until that happens, it's best for our clients and our portfolios that we be defensive and be very protective of the nice gains that we've made in the last 2.5 years. So until we update again in 2 to 3 weeks, or an event of some type occurs that requires us to, thanks for joining us here at Terril & Company, and we'll see you on the next broadcast. Thank you.